The broadcast is now starting. All attendees are in listen-only mode.
Hello, everyone. My name is Andreas Salastinos, and I would like to welcome you all to today's webinar titled Risk Management. Let's go through the agenda for today. We're going to talk about risk. We're going to define risk. And then, of course, we're going to discuss how to manage risk. And one of the tools that we're going to use is stop loss. Another tool, of course, is position size, or if you prefer, the size of the position. And we're going to talk about maximum drawdown and how to use it in our trading. And then, of course, we're going to touch the topic of reward to risk ratio. Anytime you have a question, please post your question and I will be very happy to answer it as soon as possible. Before we go any further, please type yes if you can hear me and if you can see my screen, please. Give me some feedback. Type yes if you can hear me and if you can see my screen. Give me some feedback, please, so I know that we are all online. Nobody yet? All right, very good. Okay, guys. Excellent. All good. Let's go. Now, what is risk? This is the question. What is risk? If you know what risk is, please type your answer. Let me get some answers, guys. What is risk? We are going to discuss how to manage risk, but we have to know in advance what we are going to manage. What is risk? What do you think risk is? Just give me a couple of answers, please. Let's think about it for a moment. What are we trying to manage? What is risk? All right. So perhaps we can say that, oh yes, we have, of course, an answer, risk of loss. Yes. Capital management. Said, is that Said from Bangalore? Capital management, risk of loss. Yes, very good, guys. Excellent. The potential of a bad outcome. Of course, the potential of a bad outcome, it might mean loss of money. But that's not all that has to do with a potential of a bad outcome. We can also perhaps say that is the potential of underperforming. What does it mean? It means that if we expect, for example, to make 30% profit for a year in 1 year, but eventually we make only 5%. Is that good for me if I am a fund manager? This underperforming is not very good for me, right? So no one will want to use me as a fund manager anymore if I underperform. So this is another risk. I hope you get the point. And of course, it's the potential of failing to achieve investment or trading goals. For example, my goal is to make every year 10%. But what if I make 1%? It means that I fail to achieve my trading goals. Okay, guys? And of course, as you very well said, is the potential of losing money. And this is what most of the traders are worried about, the potential of losing money. Very good, let's go on. And of course, let me remind you the essentials of trading the financial markets. We need a trading system. Everybody needs a trading system, specific rules, when to buy, when to sell, where to take the profit, and where to say, enough, I lost an amount, let me get out. Also, on top of the trading system, we need money management. In our case, we can call it risk management. We need some risk management rules, and this is what we are going to talk about today. And of course, you need psychology, you need the discipline, actually, this is what it means. You need the discipline to follow the trading system and the risk management rules. Very good. And if all these three are in place, then we have what I call the ultimate trading formula. So we have discussed many times the trading system. We have given you many trading systems so far, guys. We touch the psychology, the discipline concept, even though it's very difficult to teach that, but I gave you a lot of tips about it. And what is left is to talk about risk management. So let's go. To trade the financial markets, we need chart analysis. We have to be able to analyze the price chart. Then we need a trading system. And of course, we need our risk management rules. And we never forget discipline. This is what we just said, guys, in different words perhaps. But let me go one step further and give you more information on each topic. Analysis actually boils down to determine the direction of the market. Is the market going up or down? We have to be able to do that. So once we decide whether the market goes up or down, then obviously we will be able to know whether we are going to buy or sell. So this is what analysis is all about. Identify the direction of the market. And then based on our trading system, we're going to buy or sell. Excellent. Trading system is detailed, precise, clear-cut rules on where to buy, where to sell, where to take the profit, and where to place the stop loss. This is what the trading system is all about. Precise, detailed, clear-cut rules. Guys, let me remind you, if you have any questions, feel free to post them and I will try to answer them as soon as possible. Then, money management, or if you prefer in our case, risk management, has to do with the stop loss. And of course, the size of the position. Those of you who attended any of my on-location seminars or workshops, you know very well that my primary goal is how to minimize the loss than to maximize the profit. So our goal is to manage the risk. Excellent. And of course, what is left is to follow all these rules that I just mentioned. Discipline. Okay, let's go on. And what is risk management, of course? That's why we are here, to talk how to manage risk. Now that we know what risk is all about, which is, of course, a reminder, is the potential of losing money or underperforming or failing to achieve our investment goals. Then one of the tools that we are going to use is stop loss. If you prefer, I call it protective stop loss. Protective stop loss. And I can go one further step and call it technical stop loss, because the place where we place it is completely based on technical analysis. I will show you in a while where to place your stop loss. Position size is very important to know how much money you are going to risk in any trade. Okay, guys, let me see. We have a few questions here from Moses. How to identify the actual price you are risking by calculating the pips and the lot size. Yeah, this is what I'm going to explain, Moses. How to calculate position size. And from Ali, we have a question. What portion of our money we have to trade? I will answer that in a while, in a couple of slides. Very good. So position size, the size of our position. We're going to discuss that very detailed in a while. And we're going to discuss reward to risk ratio. It's another important concept that we have to deal with, that we have to clarify. And what do you do actually when you are winning a lot of trades, and what do you do when you are losing a lot of trades? Are you going to increase your position size or are you going to decrease it? Yeah. So these are some questions that we have to deal with. So just a reminder, this is a beautiful downtrend as defined by lower tops and lower bottoms. And we are very happy because we just see in front of us a beautiful reversal to the upside. And of course, it's a failure swing for those of you who remember our seminars and workshops. And here, when the price goes above the last top, is the precise, detailed, clear-cut rule that we're going to buy. And of course, we're going to place our technical protective stop loss at the last bottom. Okay? We have another question here by Bruce. What is a reasonable percentage to set as a goal for a return on your investment? Give me some more time, Bruce, and I would come back to you. And we have another question by Samuel. about the 2%. I will come back to that in a while. Okay, guys? Samuel, are you from Nigeria? I think I met you a couple of years ago. Very good. Let's go on. So we know actually where to place our, excuse me, guys, where to place our buy and where to place our stop loss. Now, there is a theory out there that suggests that after we buy, we place our initial stop loss at the bottom. And when the market goes to our first target, which is usually the same distance as the distance between top and bottom, then by closing 50% of the position, then we ensure that if the market goes down, then we're going to break even. A lot of traders use this concept, and please allow me to say that I tested that concept, and because most of you guys trade on low time frames, the distance between your entry and the first target is usually very small. So most of the time, or many times I should say, the market will kick you out of the trade, will hit your first target, will come down to the entry level, hit your stop loss, and then it will go much higher. And this is not a very big problem as long as you don't lose money, but the problem is that you get frustrated. And that means that you lose your discipline. And when you lose your discipline, it's a recipe for disaster in this business. Okay, I'm having more questions, guys. Based on what we have to put the stop loss, I will answer that now. Okay, very good. So guys, let me just repeat myself one more time because I received a couple of questions about that. So trying to analyze this chart in front of me, I see lower tops and lower bottoms. This is the definition of a downtrend. Then I see this bottom here that fails to go lower than the previous bottom. This is a warning for me. It's just a warning. And then I see that price goes above the last top. This is a reversal. This is called failure swing. Or if you prefer, it's a head and shoulders. It's an inverse, opposite head and shoulders. Okay, now, when I see the price going above the last top, I understand that the downtrend is finished and a new trend, an uptrend, has just started. So I want to take advantage of this reversal, so I'm going to place a buy order at this specific level here. Since I buy, I want to protect my money. How do I do that? By placing a stop loss. Where shall I place my stop loss? Based on technical analysis, if the price comes down below this bottom, let me repeat myself, based on technical analysis. If the price comes down below this bottom, then there is no reversal anymore. There is no uptrend anymore. And the probability of the market to go up is less. So I don't want to be in that trade anymore. That's why I want to place my stop loss at this technical protective stop loss right here. Is that clear, guys? Now, a new theory says that you can call it initial stop loss, and when the market goes to your first target, which is the same distance as from top to bottom, then you can close 50% of your position when the market reaches target 1. Now, if you close 50% and you move your initial stop loss to your entry right here, then if the market comes down, then you break even. Okay, very good. Let's go on. Then let me explain another theory out there, which is called adverse excursion. Again, we have a beautiful downtrend as defined by lower tops and lower bottoms. And then we have a reversal here, as I just explained, because this bottom fails to go lower than the previous bottom. And the price goes above the last top. So this is my detailed, precise, clear-cut buy entry. And then I place my stop loss at the last bottom. Now, the market goes higher, and it hits my first target. In this case, there is no movement of the price in the opposite direction. So there is no adverse excursion. Adverse excursion means movement of the price in the opposite direction. So let me show you adverse excursion. Again, we have a beautiful downtrend, beautiful reversal. I want to buy here because the market is reversing, and now I want to place my stop loss. Where am I going to place my stop loss? Of course, I can place it here at the last bottom, but now you see that I have an adverse excursion. The price comes down in the opposite direction, forms a bottom, a new bottom, and I want to place my stop loss here. Because if the market comes down in the opposite direction, below this bottom, then my uptrend is not in place anymore. So I'm going to place my stop loss right here. Okay, guys? Is it clear? Very good. So this distance from this top to this bottom is called adverse excursion. I have a question here. The question is, should we wait for the candle to close above the top of the reversal before we place a buy order? I received this question many times all over the world. In the stock market, we learn that we have to wait for the candlestick to close. It's like getting a confirmation. In the Forex market, things are a bit different. It's faster, okay? And we go as the candlestick goes above. We don't have to wait. This is my personal opinion, guys. No need to wait. Again, this is my personal opinion. Let's go on. So stop loss. It's very important to protect our capital. I know that some people don't like it because it hurts when the market hits your stop loss, but believe me, it hurts much more when your account is closed. So I believe it's better to lose just a little amount of money because of the stop loss in order to avoid losing your whole account. So we have to know in advance where we are going to place our stop loss. And of course, we know where to place our stop loss because it's a technical stop loss, as I explained a few minutes ago. It's a technical stop loss. And then, of course, we place our stop loss when we enter a position. Depending on our account, we can place a stop loss when entering or just after we enter a position. But nevertheless, we should have a stop loss when we enter the market. And of course, we do not move the stop loss due to fear. It's very important to avoid that because that means we are losing our discipline. And when we lose our discipline, once more, it's a recipe for disaster. And to emphasize that, we should honor the stop loss to protect our capital. Excellent. Let's go on. Position size. This is what everybody is waiting for. How to calculate the position size. I know that most of you guys are used to the 1%, 2%, 5% theory, right? But allow me to avoid this and give you a different way to calculate your position size. Let me explain. So again, we have lower tops and lower bottoms. And once more, this is the definition of a downtrend. And then I realize that this bottom fails to go lower than the previous bottom. And not only it fails, it goes above the last top. So I buy here at 1.3025. and then I place my stop loss at this technical bottom, 1.2975. So my risk is the difference between the top and the bottom. And I know right away the difference between the entry and the bottom, which is 50 pips. So guys, it's very easy. 1.3025 minus 1.2975. Then the answer is 0.005, which is 50 pips. This is my pips at risk. This is how much I risk. And of course, I expect the market to go higher and higher. That's why I bought. I have a question, guys, by Abbas. In volatile markets, in high movement markets, during the news, yes, should we change our stop loss temporarily? Should we change our stop loss temporarily? Meaning, should we increase our risk? The answer is no, no, no. We are not allowed to increase our risk. Okay, guys? And another question by Abbas. What is the best time frame for choosing stop loss? Any time frame is fine. The best time frame is the best time frame for you. Okay, and of course we have another question: how to close 50% of the position size? Guys, I'm sorry, it's out of the scope of this webinar. I explained that in a different webinar actually, and I don't have the time to explain it now. But very briefly, what I can give to you is that you can modify, after you buy or sell, you modify your order by minimizing, by changing the volume size to 50%. So once more, after you buy or sell, after you enter the market, you click on the terminal window on the specific order, you right click on that line and you say modify order. Then it will show you the window of your volume, and then you change that volume from one lot to 0.5, for example. And then you press modify. By doing that, 50% of your position will be closed. This is how you do it. Okay? Very good. I have another question, guys. How much we have to put take profit and stop loss? Because if our take profit is double from stop loss, most of the time I face the stop loss. I never said, guys, to place a double take profit the stop loss. And when we reach the risk to reward ratio, I will just present to you the theories. The way I teach take profit and stop loss is based on technical analysis. And that has to do with the market. And we use actually Fibonacci price targets to take potential profits. But again, please allow me to say that it's out of the scope of this webinar, guys. Okay, so just to give an answer to my friend here, Kaveh, we take partial profits as the market goes in our direction. Partial, yes. So let me come back to the position size. Very good. So let's say that I deposit $10,000. I know that you read many times about risking 1%, 2% and stuff like that. But the way I'm going to go about it is to ask you directly, each and every one, how many losing trades you want to take with your money that you just deposited. So some people will say, I want to take a lot of trades with my $10,000. Some other people will say, I don't really care. I have a lot of money. I can risk $10,000 in one trade. Or some people might say, I want to take 100 trades, 130 trades, 50 trades. So the answer is subjective. It has to do with each individual. Okay, guys, this is what I'm trying to say. It has to do with each individual. So let me just show you here. Let's say that this trader decides that wants to take 50 trades with the $10,000 that just deposited. Remembering our reversal, the entry is at 1.3025 and the stop loss is at 1.2975. Okay, now right away, if we subtract these two numbers, we get the difference, which is 50 pips, and we call this difference between the entry and the stop loss pips at risk. This is our risk in pips. Very simple, like that. Now, if we divide our deposit, $10,000, that I deposited my own money and I decided on my own that I want to take 50 trades with this $10,000, then if I make this division 10,000 by 50, then I get $200. So these $200 mean that I am not allowed to lose more than $200 on any trade. So on every losing trade, I'm going to lose $200. And if I lose 50 trades, then I will lose all my money. Why? Because this is what I decided. I decided that. So my position size based on my decisions should be $40,000. How did I get that? The formula is to calculate the position size, you divide risk per trade, remember this is $200, by pips at risk, 50 pips. So if you do this division, 200 divided by 0.0 0.005, which is 50 pips, then you get $40,000. And this is your position size. Let's go on to another example. So this guy now is more conservative. He says, no, I don't want to take 50 trades only. I want to take 100 trades. So right away, if you make the division of $10,000 divided by $100, then you find out that on every trade, you are going to lose $100 because 100 times 100 is $10,000. Very good. Now, if we keep the same entry and the same stop loss, again, the pips at risk remain 50. And since he's going to take more trades, it's logical that his position size is going to be smaller. In this case, $20,000. How did I get $20,000 or 0.2 lots? By dividing risk per trade, 100, by pips at risk, which is 0.005. If you do this division, then you get $20,000. One more example. Again, my deposit is $10,000. Now this guy is more conservative and he wants to take 125 trades with his money. This is fine. He decides what he's going to do with his own money. Now, the entry is the same, 1.3025, but this time the bottom is different. Or is it the same? It's the same. It's the same. Pardon me. Same entry, same stop loss. So if we make the division $10,000 by 125 trades, then we end up with $80 loss on every losing trade. So how much should my position be? The way to do it is very easy. It's 80 divided by 0.005. And if you do that, you end up with $16,000 or 0.16 lot. Now, this trader here now, again, deposits $10,000, but he says, look, 40 trades, it's enough for me. I can handle it. And now the entry is the same, but the stop loss is a bit different. So my pips at risk is not 50 this time, but it's 20. And of course, if I divide $10,000 by 40 trades, then I find out that I'm going to lose $250 per trade. Okay, very good. So how do I calculate my position size? By dividing 250 by 20 pips, but you have to use the decimal notation 0.002. Very good. Let's go on. So this is the way to calculate the size of your position, guys. If you don't like it and you want to stick with the percentage, it's fine with me. I'm just presenting a different way. So let me present a different concept now, which is called maximum drawdown. I just want you to realize what is going on when your capital is decreasing. Let's say your initial deposit is $100,000 and you lose 5% of your deposit. Now your balance is 95,000, right? You lost 5%, you are left with 95,000. So to break even, you need 5.26% of your remaining capital to break even. Now, if I lose 10% of my money, I am left with 90,000 and I need 11.11% of the remaining money to break even. Can you do that? Most probably you can do it. Then let's say that you lose 20% and you are left with 80,000. So you need 25% of your remaining money to break even. Can you do it? Maybe you can do it. Now, let's say that you lost 25%, you are left with 75,000, and you need 33% of your remaining money to recover, to break even. And I can go on, and let's say that you lose 50% of your capital, you are left with 50,000, and you need 100% of your remaining money to break even. Guys, listen to that. Maybe you can do it, maybe you cannot do it. That's not the issue. The issue is that if you are down 50% and your performance have to show 100% of your remaining capital, you are going to lose your discipline. This is the problem. You are going to over leverage. You are going to over trade. You are not going to stick to the precise rules of your system. And if discipline is not in place, as I repeatedly said today, it's a recipe for disaster. And of course, I am sure that you get the point, right? So what I'm trying to say is that you have to use risk management rules to avoid having a big or very big drawdown, because then the psychology factor will kick in, and that is very dangerous. Reward to risk, somebody asked me a while ago, and I said I will answer that in a while. We all read many times, let profits run and cut losses short. And also, we read that it's very important to let our profits run and take advantage of strong trends. And of course, that is very important to cut losses, so winning trades will be bigger than losing trades. A commonly used reward to risk ratio is 3-to-1. Okay? Now, 3-to-1, for those who attended my Fibonacci seminar, workshop, or webinar, or those of you who attended the on-location seminar, the Ultimate Trading Formula, you know that this is a very difficult reward to risk ratio to achieve? It's easier to say than to achieve. That's why during our trainings, we prefer to practice on locking profits, on closing partially the position. So in the Forex market, some people might look for 2-to-1 reward to risk. And of course, some other traders, instead of closing the whole position at once, what do? As the market goes in their direction, they close part of their position, it goes higher, they close another part of their position, and when it goes even higher, they take another part of their position. So as the market is generous and going in our direction, we take profits, partial profits. Because guys, the truth is nobody knows how far up the market will move. That's why you see me a little bit skeptical when I talk about the 3-to-1 reward to risk ratio. This theory is very good as long as you have a strong trend. But if the market is not that strong in a trend, then unfortunately will not achieve the 3-to-1 reward ratio, and most probably you will hit a stop loss. And to avoid that, what I do is to take partial profits as the market moves in my direction. And again, the way I do it is through the Fibonacci tool, and I will be very happy to present that in another webinar or when I come to your own hometown soon for a seminar or workshop. And of course, let me just present here the 3-to-1 reward to risk. So I buy here, guys, because of the failure swing, because of the reversal. And I place my stop loss at the last bottom. It's a technical stop loss. The difference, of course, is 30 pips. So based on the 3-to-1 reward to risk, I have to close my position at 90 pips profit, which means 1.3670. So if this is 30, my risk is 30, my profit is 90, 3-to-1. Just to give you some food for to think about, it's like closing your whole position at the third Fibonacci target at 4.236. I think it's very risky. That's why I prefer to take some profit here at 1.618, another profit here at 2.618, and then I can decide to close everything at 4.236. Excellent. So before I say goodbye, guys, let me just explain something else. Let's say that I start trading and I have a winning trade after winning trade, right? What do? Do I increase my position size to take advantage of my expertise, right? This is a question that every trader faces. Some traders will increase their position so they can make more profit. because they think, yes, now I know how to trade, so let me increase my position. Or they might say, it seems that the market has a very strong trend, that's why I win, so let me increase my position. Personally, I don't like it. I don't like to increase my position because you never know what is going to happen next. Now, what if I keep on losing money? What do I do? So some people will say, hey, listen, I am not a good trader. The market is not good. So I want to cut my position to 50%. Again, I don't like it. I have a system. I have to follow my system, and I have to keep my position according to my system. If I don't know how to trade, it's better to stop trading, learn, and then come back and follow my system. Okay, guys? All right, one more question, and then I have to go. We exceeded our time already, guys. The question is, what percentage is the third target of Fibonacci? The third Fibonacci target is 4.236 of 4.236, or percentage is 423.6%. 423.6%, which means about more or less 3 to 1. Okay, guys, thank you so much. I apologize if I didn't manage to answer all of your questions. I hope you enjoyed our webinar today. Actually, I have to thank you because I'm very happy today because it's the first time we deliver a webinar in 2 languages. Actually, our IT department here did a very good job. Actually, I have to say an excellent job. I have to thank each and every colleague of mine for this excellent job that they did. And we have this magnificent setup here. And I have a whole crew here with me, guys. And thank you guys for being here with me. And we delivered in 2 languages, English and Farsi at the same time. Thank you so much for your attention, and please keep on watching your inbox for our next announcement. Thank you and see you soon.